Hello, everyone. Thank you so much for joining us for another weekly wrap-up. My name is Jeremy Kronemeyer, Operations Manager for Wickham Financial Group. And I have Graham Wickham here, President and CEO of Wickham Financial and Insurance Services. Graham, what happened in the markets last week?
Hey, thank you, Jeremy, and thanks for our listeners jumping on another call. We saw the S&P 500 and the Nasdaq, that tech-focused area, up about 2%. The Russell 2000 small cap area, that was up the most, around 2.4%. Now, all sectors did rise, but financials lagged a little bit, despite some pretty strong earnings that we just started with the large banks. On the regional side, we saw Zion, Bancorp, their shares fell due to some losses with the commercial and their industrial loans, and Western Alliance dropped after disclosing some lawsuits over some business loans. If we look at commodities and crypto, we saw gold futures surge about 7% to nearly 4,400, then pull back on Friday. Oil, that declined about 1.7%. And the cryptocurrencies remained under pressure. They've been that way, 2 consecutive weeks now. If we look at macroeconomic data and some Fed updates, we're looking at the government shutdown. That's continued for the 3rd week. That is limiting some economic data flowing out and its ability to be reported. But we looked at Treasury yields. They hit their lowest level since April due to some economic uncertainty. Fed Chairman Powell signaled a likely quarter-point rate cut later this month. And Chicago Fed estimated retail sales rose about 0.5%, likely influenced by some higher prices. With the regional manufacturing, that was kind of mixed. Over in New York, that was a modest increase, and in Philadelphia, that was the lowest that we've seen since April, signaling some moderation in the manufacturing, moderation in the economy, but not necessarily falling off a cliff. Key thing to listen for. We're not falling off a cliff. If we look at housing market, the NAHB housing index that rose to about 37 in October. That was from 32. Future sales expectations cross break even at about 50, driven by some optimism of some lower mortgage rates, meaning that with the Fed bringing those rates down, bettering borrowing cost out there. We look at official housing starts and permits. They were delayed with the shutdown. We go internationally. China's exports rose 8.3%. The non-U.S. shipments rose about 15%. Consumer prices fell 0.3% year over year, but their producer prices were down 2.3% year over year. Trade data was suggesting some limited impact from U.S. tariffs. Now, the U.S.-China trade talks, we got Trump called proposed 100% tariffs unsustainable and confirmed a meeting with some Chinese officials maybe over the next couple of weeks. UK economy grew just 0.1% in August, where we did see the Q3 GDP may slow. The Q2 did grow about 0.2%. Employment was pretty stable and wage growth slightly cooled. Now, the week ahead, earnings. As I mentioned earlier, we started out with the large banks coming out with good, solid earnings. We're hopefully continue to see that because that can help support this market in the multiples and the valuations that we're trading at. But we got some pretty heavy hitters coming out like Netflix and Tesla and IBM, Texas Instruments, Intel, just to name a few. But we got some key U.S. economic data that'll be rolling out this week, too. So on Friday, we'll get the September CPI report. That's expected to be a positive 0.4% month over month, with year over year being about 3.1% for inflation versus about a 2.9% for the prior year over year. Flash PMI survey for manufacturing and services will be coming out, and we're looking at some revisions to the consumer sentiment and inflation expectations. Geopolitical and credit markets, they'll be a bit in focus with some progress, hopeful progress with the government shutdown having some sort of resolution. Updates on the U.S.-China trade negotiations, and maybe some developments over here with some credit markets. Internationally, we'll be looking at China getting their GDP, industrial production, retail sales. Japan, well, they'll be electing their new prime minister coming out today. Inflation update on Thursday. In Europe, we'll look at the flash PMI readings and UK CPI and retail sales data. Jeremy?
Gotcha, Graham. I had a question for you. We've been meeting with quite a few clients, and most of them are saying the markets have been doing pretty good, but do you feel like there's some pressure on the markets, or maybe looking for maybe a correction possibly by the end of the year?
Yeah, I think you always have to say, the markets have done extremely well. I honestly will tell everyone a bit better than what I thought they would have done so far this year, being up around 14, 15%. I was thinking about half that for the whole year. The year's not up yet, so we'll have to wait and see. So I would say volatility is probably going to be the name of the game, and I think you have to expect it. We've had a couple really solid years in the S&P, the Nasdaq, followed now with the Russell in the mid-cap area, kind of following suit, and international markets really leading. And so I think you have to expect some volatility. But just because we've done well doesn't mean we're set up for a big correction, 20% more or 10% pullbacks. 20% would be like a bear market and 10% would be like a correction. And we get 5 and 10% pullbacks all the time. Keep in mind that we had a 20% pullback at the height of the trade fear at the beginning of the year. So if you're kind of saying, hey, have we checked that box? Maybe we have. And just reminding everyone of some stats. And I always look at history as kind of as a guide. It doesn't always repeat itself, right? But it has a rhyme, a rhythm to it. Listen, if we go back to 1929, we've had 56 corrections in the market. We've had 22 bear markets, 20% or more, and 34 corrections. If we even go one step further, because I'll add to what you brought up, I hear a lot of, what about a recession? I hear that we're going into a recession. Well, we probably will at some point, but not today. The earnings are too good. Right. Unemployment's at 4.3%. As long as earnings hold up, I think we can justify some higher multiples in the market. Even though certain sectors of the 11 sectors that make up the S&P, you might have certain sectors that are a little frothy, where some sectors just hadn't had their day in the sun, like energy or healthcare or pharma. That hasn't. But if we think about recessions, we go back to 1854. We've had 33 recessions. That's a negative growth for the U.S. economy. We are not there. We're estimated to grow somewhere around 2.5%, if not higher, maybe moderating from that 2.5. Moderation doesn't signal recessions, and they average about 11 months. And also keep in mind, and I'll wrap it up with this, is that we probably average, one recession every 10 years. I think arguably in the last 10 years, we've had a recession. So I don't know if history is going to repeat itself, but again, I think it leaves clues. It has some rhythm. Just accept some volatility right now.
Gotcha. Well, Graham, we always appreciate the information, expertise, and thank you to our listeners that check in with us every single week, and we look forward to seeing you next week.
Take care.